counter. But right now, we've got Hemant Rustagi of Wiseinvest advisors now joining us. Hemant, before anyone gets into a life insurance product, what are the key things they should keep in mind to avoid, some big mistakes?
Well, life insurance is an integral part of the risk management process for any investors. And, having adequate insurance ensures that if something were to happen to any earning member of the family or the sole earning member of the family, the dependents at least will not face any financial hardship. But unfortunately, many investors do not focus on this very important aspect of their financial planning process. And even those who buy life insurance do not do it the right way. Thereby, they have the risk of either being underinsured or not able to achieve some of their goals. I think some of the major mistakes that investors make to begin with, the first one is that many investors do not feel the need to buy life insurance. While they happily pay insurance premium on their car or a bike, they don't consider buying a life insurance. But I think it's very important for everyone to understand that if anyone has a dependent who is going to be financially affected if something were to happen to this person, life insurance becomes a necessity. And not only that, I would say buying it at the earliest makes a lot of sense because that makes a huge difference to the premium that you pay. Then there are investors who buy only traditional plans. On which are these plans? Basically, we're talking about endowment plan, whole life plan, or money back plan. This happens typically because they do not assess their insurance requirement properly and also focus more on investment than on insurance. I think the problem with the traditional plans is that they neither provide you the kind of cover that you need, nor the kind of return with which you can beat inflation. So it's very important for everyone to understand that life insurance is to be treated as a risk management tool, and therefore it's very important to focus on products like term plan, which not only offer a higher risk cover but at a much lower premium. Then there are investors who end up having a large number of policies in their portfolio, which makes their insurance portfolio quite unwieldy. And that typically happens because many investors still consider life insurance as a tax-saving instrument. But I think it's very important for them to understand that it is not the number of policies, but the quantum of insurance cover which will give protection to their family. Last but not the least, there are investors who make the mistake of buying insurance once at some point of time and continue holding it without reassessing their insurance requirement. And what typically happens then is that many a times they are underinsured. It's very important for everyone to realize that one has to review the insurance needs to keep in line with the changing family composition, changing lifestyle, or increase or decrease in the assets and liabilities. So yes, life insurance is very, very important, but I think it's equally important to assess your requirement properly and buy the right product.
Hemant, just a follow-up question on that. Now, if over a period of time, say after 10 years, your lifestyle has changed and you want to increase the total amount of cover, so say if you had insured yourself for 3 crore and now you want to make it 5 crore, so this remaining 2 crore, does it make sense to get into a new life insurance plan, or perhaps are there options to top up your existing life insurance?
You see, like I mentioned earlier, the life insurance has to be looked at purely from the risk management tool, as a risk management tool. As I mentioned earlier, that you need to review it, reassess it over a period of time, and if there is a need, since you're talking about primarily a term plan here, you can buy another term plan, and that makes sense actually. It's not that you need to have too many, but I think having more than one makes sense, because at some point of time, if you feel that you do not require so much insurance, you can actually stop paying insurance premium for a particular term plan and carry on with others.
All right, Hemant, let's take a viewer query then. We got Brijesh Bhatia from Mumbai sending an SMS. He is 34 years old, a professional. He can invest 7,000 a month. That, of course, is separate apart from investing in a term plan. So please suggest options for him for both.
I think there are a couple of important factors you need to consider here. One is clearly his time horizon and also the existing portfolio mix. So if I assume that he's looking to invest for a long term, and for his short-term and medium-term needs, he has investment in debt and debt-oriented products, then my recommendation would be that he can look at well-diversified equity funds. He can look at funds like HDFC Top 200. He can invest 4,000 rupees in that, and 3,000 rupees he can invest in a fund like Reliance Equity Opportunity. A key factor always is when you're investing for the long term, especially when investing in equity, is to carry on your investment process irrespective of the market condition. As far as the term plans are concerned, I think there are a couple of term plans that you can look at. It's iCare of ICICI Pru, he can look at click to product of HDFC, he can look at, or e-term of Kotak. So these are some of the term plans I can consider. I would recommend going for an online term plan because that is even cheaper compared to going through an insurance agent.
All right, Hemant, thanks so much for joining us.